What's up, traders? Is Santa coming to town? That seems to be the million-dollar question now, with lots of folks impressed with the little two-day rally that we've seen so far. However, I wouldn't trust it as far as I could throw it. I think it's primarily short covering, and it's also not doing a whole lot in the context of this overall downdraft from last week. Much more on that and other trade ideas in today's episode of the Midweek Market Update, where I do a technical analysis on the broad market, followed by our core list of companies. And if you stick with me towards the very end of the video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off on the SPY daily time frame chart. What's going on from a price action, structural, and psychological perspective? So, still far underneath the overhead supply. Remember that we had these 2 equal highs, we had all of these consecutive equal lows, and finally on the fateful move from last week, we of course made the big time new lower low, putting us in a daily downtrend. So now, I would say the million-dollar question is not so much about a Santa rally, but where's the lower high going to form? Is it going to happen here off the backtest of the bottom end of the balance? It's going to be 394.50, or is it possibly going to be lower than that? I would make the argument and build the case in today's episode that 389.50 could be our meaningful lower high. Reason being is if we scrunch up this daily chart and give ourselves lots of data to look at, we've been beating this level into the ground, it seems, over the past months and months and months. We seemingly talk about it in every video. 389.50 now has the opportunity to act as potential resistance. It's been a big time level for the SPY over really most of the year, to be quite frank with you. So that's number one. This could offer some resistance from that perspective. Number two is if we take out the Fibonacci from the high of the CPI gap up to the most recent low, your 38.2 Fibonacci is aligned beautifully with that, offering up bear flag consolidation there. And we're also continuing to see rejections and a little bit of stalling out here towards the highs of today's session around noteworthy areas of resistance. Number one, Friday's high, where we got a lack of gap fill on that particular day. It's the low of the CPI gap up from the November read. It's the daily 50 SMA. That's the blue moving average on your screen. And if we throw on some anchored VWAPs that we've been watching, and do something like this to show you where they're coming from. 2022 low, anchored VWAP, confluence of resistance. The last trend line touch, the big pivot high from here, anchored VWAP, also confluence of resistance right around where we're currently trading. If we zoom in just a hair and look at the anchored VWAP from the CPI gap up, that's coming down as resistance as well, right towards that 389.50. We also have the upper edge of the weekly expected move there. So overall, you could make a pretty strong argument that this might be a stubborn area for our chart moving forward. If we have a look at the hourly time frame chart, I think we see some more evidence that kind of supports this as well. Number one, we get a gap and go on today's session, so fairly indicative of short squeeze right out of the gates, and then it's just sideways into the close, right? So it's not like we had sustained buying pressure throughout the course of the day, never mind into the close on any sort of major imbalance. And you could say, okay, from a very textbook perspective, sure, we've got a bull flag, great, bulls are in control, high and tight consolidation. Taking a measured move from this brings us just shy of that 389.50. So if that's where the bullish momentum runs out from the pattern perspective, can the daily lower high be offered here? Certainly does strike me as a reasonable possibility. The other thing would be, all right, let's say that we get a pattern that fails, breaking down underneath 385.50. There's very little support through this rally that we saw early on in today's session. I'll show you that on the market profile. So a breakdown there also opens the door for the sellers to get us closer to 378.50. So we've been pretty bearish so far, and I think the evidence would support that bearish stance. The one thing that would start to change or complicate things is if we do make a move over 394.50, my goodness, what a tricky market we would be in if that is the case. We would have to reevaluate, depending on the circumstances of how we get there. So I'd at least like to acknowledge that, but it seems like a low probability outcome as of right now from the evidence that I can see. Let's have a look at our market internals. If you're not familiar with this screen, top right-hand corner's got you covered with a brief tutorial. We'll give credit where credit is due. On today's session, the volume reads were actually fairly impressive, up and over 300 million, and the net flows cumulative on the week flipped to inflows from outflows. So again, credit where credit is due, decent job, buyers. Same thing with the advanced decline line, up there in trend zone throughout the course of today's session, decent job. This is where things get really telling. The tick is the one that tells the truth every single time, right? This does not matter where you are in relationship to the prior day's close. Notice that the tick throughout the course of the day actually trends lower, right? And this is really important. This helps sort of not prove the point, but increase the odds of saying that, yes, this was in fact short squeeze that we saw on the morning session, right? We open on the gap up, and I think anyone who is really short from the Bank of Japan news over here were the ones in hot water. On the open, this tick is telling us, right, the fact that it didn't immediately correct to the zero line, that it's just buy, cover, get me out of shorts, I don't want to be in shorts. And then throughout the remainder of the day, I mean, if you just isolate the tick to looking at this, it's neutral at best, right? Look at your cumulative build. It's bullish on the sustained action over the zero line, and then into the end of the day, it's flat. It is not, it doesn't get more bullish into the close. So to me, again, indicative of short covering and not so much new money buying. So that's my interpretation of the internals. You can take the data for what you will. And let's have a look now at our market profile. Top right-hand corner's got you covered with a brief tutorial if you don't know what this one is. Overall, some main takeaways continue to support the idea of short covering. Whenever you see a P-shaped profile, that is indicative of short squeeze, right? Very emotional buying in the first two periods, and then it's just sideways up at the highs. It's not continued sustained trending type activity, which is really what you get when you see more of a elongated profile that's evenly distributed. So that's indicative of short squeeze. I would also like to point out, again, you could think of this as a bull flag that we were just looking at on the SPY hourly time frame chart. If we crack the lows, let me move those crosshairs. If we crack the lows, the value area low, let's just call it 3,900 for round numbers in the ES. The volume there is virtually non-existent, so not a whole lot from a volume support perspective. So again, a failed bull flag pattern opens the door for the sellers to bring us back to the equal lows here. In terms of rallying first from a market profile perspective, if we scrunch this up a little bit, if we rally into the SPY 389.50 level, which is roughly equivalent to 39.50 in the ES, the discrepancy in pricing there is slightly off, but you can see that that keeps us underneath this post of single prints, which would keep the sellers content and offer a decent inflection point for a rollover, and there's your daily lower high. So that's what I've got from a market profile perspective. There aren't really any major deficiencies on the high or low of today's session. Again, this does have meaningful excess. I would say we only have 2 ticks of excess towards the top. It's not meaningful excess, but it also isn't a poor high. Not overly concerned with that. I want to show you something new. This is the 1 week relative performance of our sectors. So we're going to dive into the sectors now of the S&P. And this is, I wanted to include this because it can be slightly misleading to only look at one singular day's worth of performance. So here's the week as of right now. And what I would just point out is look at the bottom 3. These are all of our risk on sectors. They're all struggling. Tech is down. Consumer cyclical is the XLY consumer discretionary. That's down. Communications is down as well. Up at the top of the board, energy is the only green name on the board. That is D for defensive, again, signaling risk off posture. Consumer defensive, is also up towards the top. It literally has defensive in the name. That's your XLP consumer staples. Utilities are up towards the top. Financials are up there, but overall the structural chart will guide us on that one. So the weekly performance is still saying risk off. Now, if we take a look over here back on the Thinkorswim platform at our performance on the day, can be slightly misleading, which is why I wanted to include this in today's episode, right? XLK was technically leading the pack today, up 1.19%. The XLE is at the bottom of the barrel, down 0.14%. So this would look really risk on, but when we look at the weekly performance, not so much, right? In terms of the heavier weight sectors, obviously the XLK is the heaviest weight sector, the tech sector up 1.19%, XLF, financial, second heaviest weighted sector, up 0.59%, and the XLV for healthcare, third in our lineup, second by market cap, was up 0.7% on today's session. Let's look at the structural charts though, because again, these will continue to light the way in terms of what's happening. Notice that the XLK, big look above and fail underneath this overhead supply now. So just like your SPY, really lower highs can happen anywhere underneath 129.50, struggling at the 50 SMA, getting acceptance back in this overall range from right here has to strike you as being more bearish than bullish. Obvious opportunities for lower highs and sustaining a new downtrend here being the heaviest weighted sector. This is not out of the woods by any stretch of the imagination. Anything that just continues down here is bear flag. Anything that gets acceptance over 129.50, it's a step in the right direction. Maybe it's look below and fail, but I wouldn't really think of it like that. Technically, we had the full range double on the move to the downside, so that's kind of off the table as a look below and fail now, but there's still obviously the opportunity for a lower high still within this range, considering that this was a failed higher high. Right? So XLK, I'm not seeing any evidence yet, at least, for a bullish reaction here. Strikes me as a bearish data point for the market. Let's speed up through the remainder of the sectors. The XLC, I mean, very evenly split, but for now, you could call the balance area a number of different ways. Spending, time underneath, break, retest, looking for lower. You could say, a retest here or sideways consolidation is a flag, and then a breakdown. Even if we move higher, we're still in the lower third of this range, right? So this does strike me as a bearish sector, again, being one of the more risk-on sectors. Not a great look for your market, continuing to see that bearish posturing, defensive posturing. Utilities hanging out a little bit higher back inside of the 6-day balance from here. Reasonable pullback, right? Look at your trend count. We're just continuing to produce. This was kind of an equal low from here to here, but coming off of a higher high. All right, not the end of the world, right? Looking for Continuation in the upward direction, remembering that this is D for defensive, doesn't really bode well for a bullish S&P. Next up is the XLI. What's going on with industrials? Backtest of 99. So a lot of things that we'll see today are just break, retest, looking for the lower highs to come in. The candle did close fairly strong, so I'd be curious to see how this one resolves here, but still feeling more bearish than bullish, especially considering that this higher high did not produce a higher low for trend continuation. Like we had been talking about, this is starting to look much more like distribution here. Want to see that bearish outcome for a red S&P. Next up is the XLV. This was one of our neutral data points in the weekly watches video from Sunday, remembering that this level around 133.50 could offer some support, and it certainly did, and this is keeping our market neutral here. Remember that the XLV is the second heaviest weighted sector by market cap, so it's really important that it participates in rallies, but remember that it is technically D for defensive in terms of the tone of the sector overall. So to see this higher, it's like, okay, fine, it'll keep the S&P afloat, but it's not really aggressive bullish considering the weekly performance of the XLK that we just saw. Financials also have the big opportunity for a lower high anywhere underneath 34.50. We made the big lower low from here to here. We've already got lower highs in place. You could have called this a head and shoulders pattern, right? So all things considered, it's not bullish by any stretch of the imagination. We've got confluence of the two big moving averages here. Strikes me as even if we do rally, still looking for the lower high off of 34.50 and continuing the downtrend. Closes above, just like we said in the S&P, we'd have to reevaluate the circumstances, but there's still the opportunity for a lower high somewhere in there. It would just be a little bit trickier to pick off. Next up is the XLP, consumer staples, defensive in nature, breaking down from the balance, hitting that target, doubling the range, just going sideways in here. It strikes me as okay. For continued bearish looks, you either want to see this higher, outperforming the S&P, that's that flight to safety, or just continued bearish pressure is still bearish pressure for the S&P underneath 74. So I'm not as concerned with the XLP for the bearish outcomes. This one could go either way, to be quite frank with you. Next up is the XLY, consumer discretionary, just getting absolutely destroyed with Tesla relentlessly moving lower, which we'll see momentarily. But as we've been pointing out, here's an overhead range, break, retest, just looking for the lower highs here. Nothing more to say than that, right? It's got to continue to be bearish as long as we're underneath that 137.50, the intermediate top of the bottom, of the range. Next up, XLB materials, lightweight sector, breaking down, clear opportunity for a lower high on any back tests of 80.75. Inverted hammer on today's session, rejecting the 200 SMA. Not thrilled about any bullish outcomes here. Next up is the real estate sector. Remember that this has much more to do with the wealth effect. It was kind of neutral through here, only concerned for bears on big new lower lows underneath 34. A slight bullish pressure over 39 again, but as of right now, chart definitely looks more bearish than bullish from a pure price action perspective. Not great for the market. And then lastly, XLE for energy. What's going on here? Possibility of a daily double bottom. I would watch out for that, right? A breakout over this neckline here at 87.54 is technically bullish in energy, which as a defensive sector would not really bode too well for your S&P 500 catching any sort of meaningful bid in the upward direction. So watch 87.50. To me, it's more comfortable if you're a equity bull and you're looking for stocks to start improving and moving upwards. You probably want to see energy cool off and stay in this balance area here. Let's have a look now at our ratios. What's going on in the ratios? So top right-hand corner's got you covered with a brief tutorial if you don't know what this one is. Overall, the top four are the risk-on sectors. Notice that the XLK continues to just be stubborn. It can't get out of its own way. Just a really horrific-looking chart there, not signaling any kind of risk-on. XLV is kind of topping here, rolling over a bit, but still impressive with higher lows. Remember, it is D for defensive, though, so it's not going to save the day for the risk-on sectors. XLF, really more sideways here, getting some acceptance underneath the 50 SMA gold line. XLY is just in the gutter. It's been there for a number of weeks now. XLI, fine. Really not going to make or break your S&P. It's been a big force for the rally recently, but I don't think it's going to continue to have legs here. XLP, consumer staples, just getting a back test again of the top of this range here as it continues to trend higher. Remember that as a defensive sector, this does not bode well for your S&P. Energy picking up, utilities picking up over that 50 SMA, and real estate just kind of sideways here. A nothing burger. Overall, I would say that the sectors continue to illustrate in this look a risk off or defensive posture. Let's have a look at the XLY over the XLP. So remember that this is growth versus value, making new lower lows. Remember that this too is just a bearish look for our S&P, not helpful from that perspective. Let's have a look at the dollar. Some interesting things here. We'll give some commentary on the whole Bank of Japan thing as well. Dollar actually backed off underneath the 105 on the Bank of Japan announcement there. Should come as no surprise as they look to strengthen their yield curve. Well, I should say as they adjust the yield curve, it strengthens the yen, and of course that puts pressure downwards on our dollar here. We can actually take a look. Let's go ahead and go USD JPY. Do we need a slash? Probably do. There it is. So you can see just big pressure on the dollar when that announcement comes out. And the other thing is that, you can see from a couple of perspectives, gold is confirming this. If we take a look at the GC, gold, the gold contract here did move higher, and commodities pricing is being affected by this. If we take a look at something like corn, I think that's XC, yeah. XC moving higher on that news. So I think the fact that the BOJ did what they did and put pressure on the dollar lower, typically we would think of that relationship as bullish for equities, which it has been over the past couple of days, but I think it's really more of a driver for global inflation, which is bearish in the long run, right? So I don't think that the Bank of Japan news at the end of the day is really a positive force for U.S. equities. So with all of that said, we can go back to our United States 10-year yield and have a look at the signal study. What I want to point out here is the threat to the zero line, right? And as we cross through the zero line from negative to positive, typically that leads to downward price action in our S&P, and we're threatening it. Remember, I will continue to update you guys on this one as we continue to get closer and closer and closer. To me, it seems inevitable that this is sort of bearish for our market. And again, knowing that the 2 days up that we've seen over the past 2 days of trade is really attributed to short covering, it's not new money buying. This, when and if it catches up with our market here, shouldn't bode well, right, for equities. They should move lower. Remembering that this impacts, of course, the XLK, the heaviest weighted sector of the S&P 500. So that's what I've got from that perspective. Fed Watch Tool is up next. I just want to continue to point out that this is showing us the bailout from the Fed. So calling the Fed's bluff, calling the terminal rate at 475 to 500 instead of the plus 500 that the Fed had been saying in the SEP and otherwise. And the rate cut is first coming in September of 2023, which it was in November, a couple of days ago. But the further that this moves this way, the first rate cut that is, the more it would just imply that the market's really nervous about that earnings recession and needing to be bailed out by the Fed. And if we take a look at the 2-year yields, this continues to sort of illustrate that, yes, markets are pricing this in, and this is not just a glitch in the Fed tool, right? As this comes off, typically this leads the effective Fed funds rate. Throughout history, typically what will happen is the 2-year comes off first, and this is going to be a terrible comparison, but just look at this pivot here. When the 2-year starts to come off, it is indicative of like flat in the rate, and we're looking at that currently taking place here. So expecting another couple of rate hikes, then flat. It's not like the tool is off. The 2-year is projecting that as well. Let's go back on over to the platform and have a look at our TLT just to see if that flight to safety trade is still taking place, and it kind of is, but it's slowing down a little bit. Let's take a look at the daily. Notice that we're coming off here, obviously, as those yields go up a little bit, and the rate of change, or I shouldn't say rate of change, but the strength compared to the SPY is definitely, stalling a bit here. It's not completely died out, so I would continue to keep an eye on this, but it's not as clear of a trade as it was. You could say we're getting a little bit of a pullback before the next leg higher. It's a possibility. Just keep an eye on your TLT to continue to indicate that flight to safety type trade. Let's have a look at some volatility products now. The VIX is up first. VIX actually made the move underneath 2050, and this doesn't sit well with me personally in the VIX here. And I don't want to be too personal about this because, again, it's about interpreting the data, not my thoughts. But I think about the BOJ stuff, right? Bank of Japan, and if their yields are going to start to become more attractive, if investors are going to pull out of possibly the U.S. markets and go to a domestic market, Japanese investors, then what does that mean for liquidity here? You go down the rabbit hole again. I don't want to be overly subjective about that. But for now, the fact that this is coming off, yeah, sure, we had an up day in the SPY, but overall, right, I still think that recognizing we're underneath the balance, there's still the possibility of a higher low, the spikes. I just don't think we're out of the woods yet from a volatility perspective. What would have me feeling more comfortable would be, all right, if this comes down and really spends, a month, 2 months sideways underneath 2050, all right, fine. Maybe things are cooling off from a vol perspective, but I do think that opens us up to the complacency effect where if volatility stays too low for too long, the slightest uptick in volatility gets real nasty, and who knows, maybe we see another downdraft that looks like this. So I would say that my interpretation of volatility won't be too useful for today's session. In the short term, this of course is bullish, but in the long term, it's kind of perplexing. I don't really think it's an accurate reflection of what's going on in the markets. And then if we take a look at our VVIX, it's just absolutely floored here to the downside, which again is totally indicative of nobody being prepared for, nobody's got SPY puts, nobody's got VIX calls here. That's what the VVIX would tell us. So again, that complacency effect is there, but as of right now, you got to take it at face value. And I suppose maybe it's a slight bullish data point for our market. The same thing could hold true for our futures. In volatility, right, contango, strong contango here as we continue to move lower. You could look at this one as well if that's easier to understand, 9-day versus monthly VIX, just issuing or indicating rather, I should say, that the delta between risk in the present day versus in the future is increasing, which money managers do like to allocate capital to our markets. So kind of a confused look from a volatility perspective. Maybe I'm just interpreting it completely wrong and getting too subjective on that, which I try not to do. But today just seems like one of those days where I need to make some kind of comment on it. Let's take a look at the Qs. What's up with the rest of the broad market here? What's going on? Certainly still a similar look to our S&P. There's your overhead supply. Ideal lower highs are anywhere underneath 281.50. Just like in the S&P, you could make the argument that rejections might come in a little bit early. We don't quite have the confluence of resistance here. We can throw on the anchored VWAPs from the same exact dates and just point out that your lower high could be much closer to that area. So if you are looking for rallies, if you're looking for upside in this market, you probably want to look at the Qs moving into 281.25 instead of trying to push that SPY through the overhead resistance, right? Look at where it's easier to move. And it's, to me, it's quite clearly here in the QQQ if we see upside in the first place into the remainder of the week. So I would watch that if you're looking for bullish trades. If you want to be bearish in the Qs, just consolidation here obviously preserves a very healthy bear flag consolidation, or doing something like this. You can see the 38.2 is starting to get in line with that anchored VWAP as well as the 50 SMA here on the daily time frame chart. Next up is IWM, and this one is kind of interesting because if we take a look at the hourly bull flag, so first of all, let's just get the anchored VWAPs out of the way. Confluence of resistance is most strong up towards the top of the weekly expected move and the bottom of this little balance right here. I would say that you want to watch out for 178.50. So enough of that. Let's sort of clean this up a hair here and then go to the hourly. What I would point out is that, so the Qs and the SPY put in the bull flag consolidation sideways. Look at the IWM. It's been acting as a leader. We know that. It already broke down from the flag, right? So is this going to be an advanced heads up, an advanced warning that the SPY is going to break down from the flag, the Qs are going to break down from the flag? I can't say for sure, but as the IWM has been acting as a leader, I would definitely take it into consideration for tomorrow's morning session. Last but not least, on the look of the broad market, let's have a quick peek at the weekly candles that are shaping up. You'd be, we're pretty bearish, but look at the weekly candles that are shaping up. They're hammer candles here. So ultimately, are we going to get a reversal and do something like this? It's possible from the weekly time frame chart. Again, trying to keep a balanced approach here in our analysis. If the weekly starts to put in a higher low and we do get a rotation back into 394.50 and above in the SPY, just to keep it easy here, then, sure, weekly higher low, equal high. Maybe something is afoot for the beginnings of next year. Again, as of right now, I think the daily chart is offering some pretty solid signs of rejection underneath that 389.50. But again, trying to be open to all possible outcomes. This is something that's at least worth taking into consideration. All right, let's get through our core list of companies. Then I've got some trade ideas for you, and we'll send you on your way. Apple is up first. What's up with Apple? So a little bit of an oversold bounce off the lows. Again, strikes me as very, very reasonable. Looking for any rejections off of 137.15 or even all the way up to 140.50. This trade would imply that there's some upward room to run into the remainder of the week. This one offers bear flag and looking for lower. Here's the hourly chart. Really telling, just like everything else. There's your bull flag. So treat it very simply underneath 134.85. You know that we're rejecting here for the lower high. Start to retarget 130. If we take out the bull flag and we actually break it, look for that 140.50 to offer the lower high on the daily time frame chart, something that would look much more like this into the future. Next up is Netflix. What's going on with Netflix? This one's really tough. I hate the way that this pattern unfolded. If you've been tuning into the live streams, you know that. I would primarily keep an eye on the overhead gap over 303 gets interesting to close that overhead gap, or if we take a look at the hourly time frame chart, notice that even if we do fall here, there's some congestion back around this 288. So the short is not as obvious to me inside of Netflix, primarily focused on the overhead gap and whether or not that closes into the remainder of the week. Here is the absolute untouchable for the market. It's Tesla. No one wants a piece of this, where the market saw a dead cat bounce and rally almost across the board entirely. Tesla could absolutely not get in gear. It's just really falling out of favor quickly with most investors. Taking a look at what's going on here, really sideways. So I would say that this opens up the possibility for the squeeze happening tomorrow. The fact that we just went sideways here and new money shorts aren't getting paid. I'd watch 139.50, but only for a dead cat bounce. If we go back to the daily time frame chart, we know we've got strong overhead resistance now at 155. So, maybe a possible, take the contrary move tomorrow over 139.50 for a bit of a squeeze. It plays catch up to the market. Maybe the market goes sideways. That would seem reasonable to me. This thing's been absolutely bludgeoned. I would say it's not ideal to be fishing for new new money shorts dead on these lows. You've got to position better with some sort of lower high. So Tesla, be careful if you're looking for the short. I would say, given the positioning, the risk reward is actually better for the long. Next up, Google, looking for the lower high anywhere under 94.65. A couple of days higher here, participating with the market. Here's the hourly time frame chart. Head and shoulders, maybe. I wouldn't read into it too much. Even if we break, measured move only brings us to a lower high well underneath 94.65. So going back to the daily, I would let this one pan out. Do something here, look to position for the short on that lower high, and then retarget the equal low. If it does, build out bear flag consolidation, beautiful. Just look for the move underneath 87.25. After 2 days of sideways here, I would be willing to look for continuation. I wouldn't feel like I'm chasing it in the downward direction. Meta, this continues to be absolutely ugly. So Zuckerberg's fantasy land isn't offering us much in terms of trade ideas. Here's a sideways range. Here's the midpoint of that range. That's almost where we closed on today's session. It's 2 days up, today down, up, down, back and forth. Patience, over 124, closes the gap up towards 128.40, or just underneath the bottom of the range at 114. And even the more patient traders than that want to see 109.25 give for the move here. So not much going on in Meta. I would probably put that one back burner for the remainder of the week unless it breaks those ranges we just discussed. NVIDIA is also a tricky one. I was kind of the belief that we were going to go lower on the trendline breach and the open underneath today, but we rallied back above. So hey, maybe it's still in play until proven otherwise. I would watch for just the head and shoulders pattern now, right? If you can start to see something that looks like this, lower highs from here to here, now it's in play underneath the neckline, trend line, and boom, your 152 becomes the target once again. Kind of skeptical of longs given this big fake breakout. We could reassess if we get like a higher low above these areas, but so far the risk seems to be the head and shoulders. Next up is Microsoft. What's up with Softy? Dead cat bounce off the 100% retracement. Beautiful. 50 SMA providing a little bit of dead cat bounce, just like in NVIDIA. You want to watch for your head and shoulders. Watching for the lower high, ideally, it's underneath 247.75. Reject. Equal low, call it an H pattern, call it a bear flag, and then you're looking for this gap to close underneath us here. The bigger breakdown takes place underneath 238.50. Last but certainly not least, we got the mini beast. What's going on with Amazon? This one does look tradable on the break and retest, looking for just continued rejections tomorrow morning around 87.75, right? Rejections off of this. In play for your daily lower high. Watch it to the downside underneath the equal lows. If we can catch an intraday position off of this level, beautiful. The target is 80 on the downside. If we get price acceptance here, we are breaking back up into this range. Look below and fail is on the table, but as we know, whenever we have a situation like this, buyers have to prove themselves with the higher low first before getting aggressive on the upside. That's the core list of companies. I've got 3 trade ideas. RCL is the first one. This is Royal Caribbean. Looking for a breakdown of this area right here. You can see multiple inverted hammers, all of these equal lows, 50.83. If it breaks, we got really thin structure from this earnings gap over, well, it was a gap close, really, gap and rally. I'm not saying we go all the way to 46 in one fell swoop, but there's just a lack of structure in this general area from that prior historical move. So underneath 50.83 gets interesting RCL. Next up is sort of a 2-for-1, if you will. ENPH, Enphase, and First Solar are going to round out the trade ideas. Bullish engulfer. We open in the midpoint of the prior day's range. We take out the low, take out the 50 SMA, and rally for a really strong and impressive close over these highs into the end of day. So as long as we're over 311, here's the hourly chart. As long as we're over this prior area of resistance on any pullbacks, looking for longs. Anyone who is short in here is absolutely getting the short end of the stick now, if you will. And we're looking for the higher low to pull back. Those shorts have an opportunity to get out for break even, and then we continue to move in the upward direction. So bullish here on Enphase over this failed bear breakdown, right? They just did not have it going on in that lower wick. Looking to ride some of that momentum up to these equal highs. The target much closer to 336, and then a very similar pattern unfolding on FSLR. There we go. And you can see that we didn't quite take out the resistance area yet, but the same pattern holds true on the lows. We take out all of these lows, we support the 50 SMA, and we close back up at the highs. Here's the hourly time frame chart. Where's the resistance area? Over 161.36. Technically, we breached it and closed above into the end of day today, but I would just watch for, an open that does this and then breaks it again. Beautiful. 167.25 is your target coming from this prior breakdown point right here. So solar, it's got some bullish edge going on considering what we saw on today's session. That's going to wrap up today's video. If you appreciated it or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. We will be live tomorrow morning at 8:30 to do the pre-market prep. And with that being said, I wish everybody a green trading week.